class, and welcome to Chapter 6, Deductions and Losses. We're going to speak about deductions and losses today. So let's get right into it. So what are deductions? Well, Internal Revenue Code states all income is taxable unless specifically excluded. It states that no deductions are allowed unless specifically allowed, and it lays out a parameter for deductibility. So taxpayers must meet criteria before an expenditure can be deducted. So what types of deductions are there? Well, under Section 162, there are trade or business expenses. Section 212, deductions available by individuals for production of income. And then there's other specifically permitted deductions. We talk about, when we're looking at deductions, whether or not they're for or from adjusted gross income. We've talked about this a little bit before. For adjusted gross incomes, deductions are before the figuring of adjusted gross income, whereas from comes after adjusted gross income. And so for deductions are things like business deductions, moving expenses, IRAs, self-employment health insurance, whereas from are things like exemptions, the greater of the itemized or standard deduction, etc. So for AGI deductions, trade or business deductions, reimbursed employee business expense, loss on the sale of trade or business property, expenses for rent or royalty, retirement plan or moving expenses, alimony, penalties for certificates of deposit, retirement plans, MSAs, student loan interest, and 1/2 of self-employment taxes. Where 4 AGI expenses are recorded directly on page 1 of Form 1040 or on separate schedule totals transferred to page 1 of Form 1040. So limitations on deductions from AGI. So there's certain expenditures that must exceed a threshold before the excess can be deducted, such as medical expenses, casualty losses, and miscellaneous itemized deductions, such as unreimbursed employee expenses, expenses in producing investment income, and tax preparation fees. These things all end up on Schedule A, your itemized deduction schedule. So there's certain deductions may have other limitations, such as charitable contributions and overall limitation for wealthy taxpayers for itemized deductions. This comes through as AMT, alternative minimum tax, and charitable contributions are limited to 50% of your taxable income. You can't deduct more than 50% of your income. So criteria for deducting business and investment expenses. So business or investment activity has to be present. The expense has to be ordinary and necessary and reasonable. It has to be documented and then incurred by the taxpayer in order to be deductible. So business has to be conducted for profit in order to have deductible expenses. So expenditures must be because of a profit-motivated activity. Individuals can deduct expenses if activity is engaged in for profit and trade or business activity must be separated from investment activity. Expenses must be ordinary and necessary to be deductible. And then hobby and personal expenses do not equal trade or business expenses. If it is trade or business, then there's more flexibility in deducting the losses, such as losses on sales of assets can be treated as ordinary losses. And trade or business expenses are usually deducted for AGI, where there are much fewer limitations. Section 179 of the IRC says that deductions are permitted. It permits immediate deduction of up to 500,000 of newly acquired trade or business assets. This is an accelerated depreciation. So Section 179, accelerated depreciation, allows you to take more deduction in that first year for purchasing new, not used, only new business property. And then trade or business equals the holding of oneself out to others as engaged in the selling of goods or services. So you have to meet this definition in order to be considered a trade or business. Trade or business investments. If they're held for investment, then limitations may apply. But if they're used for business, for creation of income, then the limitations may not apply. So the loss on sale of an asset created as a capital loss, which is subject to the capital loss limitations. It may be subject to hobby loss rules, which disallow losses if it's not for trade or business. And deductions are from AGI and may be subject to income limitations or thresholds. Legal and accounting fees. If they're incurred in ordinary course of trade or business, then they're deducted for AGI. It includes tax preparation fees for Schedule C's, E, and F, and all other tax fees must be from AGI on Schedule A, subject to 2% of adjusted gross income. Legal fees for purchasing property must be capitalized to its cost basis, and legal fees incurred for personal reasons are not deductible. Certain expenses which normally would be deductible may be required to be capitalized under Section 2633. So we must capitalize costs if it provides permanent improvement or betterment that increases the value of any property, or it restores the property to its normal usage. And we're familiar with these rules based on how we either capitalize or expense business expenses in our normal GAAP accounting. Capitalized costs are added to the property's basis, and the Section 266 allows the taxpayer to elect to capitalize items that normally would be deductible. So interest and taxes incurred for personal property until it's placed in service, property taxes, interest, and carrying charges on unimproved and unproductive real estate, and taxes, interest, and other expenses in the development of real property. But under 265, no deductions are allowed for expenses associated with exempt income. So it prevents the taxpayer from obtaining a double tax benefit, right? Because if the income is exempt and you're not paying tax on it, you shouldn't get a benefit associated with expenses that are associated with that income. And then interest expense on debt used to acquire tax-exempt securities is the most common situation where you wouldn't be able to deduct that interest expense. Expenditures contrary to public policy. So there's no deduction if payment is illegal and the penalty or fine from an illegal act. So an example, illegal payments to government employees or other illegal payments such as kickbacks, rebates, and bribes under Medicare and Medicaid, payments of fines and penalties, and treble damages under federal antitrust lawsuits. So this is interesting because why would somebody report something they're doing as illegal, right? So I'm sure that many of these expenses end up on tax returns still, but we should know the rules anyway. So there's a difference between a kickback and a rebate. So generally, an illegal kickback is non-deductible. A rebate is a reduction on the purchase price of an item and is a reduction of income. The rebate must be paid to the purchaser, not a third person, in order to be excluded by the payer of that rebate. While bribes, kickbacks, and fines and penalties for illegal acts are not deductible, ordinary and necessary expenses in running the business obviously are deductible. So a taxpayer must report income from illegal activity. However, if the activity is drug dealing or trafficking, then no expenses are deductible. Who would report income from illegal activity, however? So this is where it's kind of an interesting law, but how many people are reporting income from illegal activity? Now, this has become a little bit tenuous in the drug world for states that have legalized marijuana. For medical marijuana purposes or recreational purposes, the federal government has become a little bit more relaxed on medical marijuana purposes, but recreational marijuana is still not accepted in any way, shape, or form by the federal government as a legal activity. So if you're operating a business in, say, California now, or Colorado, or Washington, where you're selling marijuana legally per state law, well, that income is technically still from illegal activity for federal law. So your expenses related to that income would not be deductible for federal purposes. So that obviously can present some problems for those taxpayers. Let's talk about lobbying and political contributions. Generally, expenses associated with lobbying or direct contact with legislators in order to influence legislation are not deductible per Section 162. The exception is influencing local legislators, city or county on matters of direct interest to the taxpayer's business is deductible, such as petitioning city regarding proposed zoning ordinance that might affect your business. The exception does not extend to state or federal legislators. Section 195 allows a current deduction for startup expenses in year the business starts. So the current deduction is the lesser of actual amounts spent or $5,000 with a phase out for amounts over $50,000. So the rest must be capitalized and amortized over 180 months, starting in the month that new business began. So the timeline for investigation and pre-opening expenses. So business investigation expenses, decision made to purchase something for the business, pre-opening expenses, then the business opens, then we have Section 162 expenses. So here's a flow chart discussing this. So we start, are expenses incurred by a taxpayer already established in a similar business? If yes, then the expenses are currently deductible and Section 195 does not apply. If not, we ask, does the taxpayer enter the new business? If yes, Section 195 allows the taxpayer to elect to currently deduct a portion of costs and amortize the remainder over a 180-month period. If not, they're generally not deductible. When expenses are deductible under the cash method. So the general rule is deduct when expenditures are paid. Exceptions are prepaid expenses and prepaid interest expense. So prepaid expenses, we know what these are. Generally, they're not deductible when they're paid. The exception would be prepaid rent can be deducted when paid if the period covered by prepayment is less than 1 year and prepayment is required by the lease. Generally, the taxpayer can only deduct over a period of time to which interest expense relates. So, I'm sorry, we're talking about prepaid interest. So we can only deduct over the period of time to which the interest expense relates. If the taxpayer receives discounted notes, then they only need to recognize interest income when maturity value of the note is paid. Exception, points can be deducted if form requirements are met. So points on a loan. So the amount is specified as points in the agreement. Points are a percentage of the loan. Points are an established business practice in that region, and it's paid to purchase principal residence, which secures the loan. So prepaid interest continued. Points paid by the seller are treated as if purchaser had paid them. Purchaser is entitled to deduct the points. If the taxpayer refinances a mortgage, points are not immediately deductible but must be amortized over the term of the loan. Unamortized points can be deducted when the taxpayer terminates the loan by another refinancing or the sale of the residence, and they're usually deducted on Schedule A, Form 1040. Accrual method. So taxpayers can deduct amounts paid if both criteria are met. All events test, and if it meets the all events test, and the economic performance test. So what's the all events test? The all events test has two requirements. So the existence of a liability is established, and the amount of the liability is determined with reasonable accuracy. So the exception to the economic performance test must meet these criteria. So all events tests met during the year. Economic performance occurs within 8.5 months after the close of the tax year. Expense is recurring and taxpayer treats as incurred during the tax year, and it's not material or better matching. So if those things are met, then the economic performance test is deemed to have been met. Let's talk about wash sales under Section 1091. Generally, losses on sale of stock or securities are disallowed in year of sale, and if taxpayer realizes a lost sale and acquires substantial identical stock or securities within a 61-day period, extends from 30 days before and after the sale. So this prevents you from basically selling a stock and taking a hit on that stock and then basically immediately repurchasing that stock. Exceptions are dealers may recognize losses or intent was not to generate an artificial tax loss. Related party disallowed losses. The original seller receives no tax deduction. The purchaser's basis equals the amount paid. And upon later sale of property, purchaser may decrease recognized gain by disallowed loss. And if disallowed loss is greater than the gain, then the unused loss disappears. You don't get to recapture it. What about related parties? What are related parties? So a spouse, lineal descendants, children, right? Brothers, ancestors, sisters, and half-siblings. These are considered related parties for tax purposes. What about other related parties? So if an individual owns greater than or equal to 50% of the value of the stock of a corporation's outstanding stock, grantors, beneficiaries, and fiduciaries of a trust, between a corporation and a partnership, if each owns greater than 50% of each other, greater than or equal to, and then between two corporations, if at least one is an S corp, and if one person owns greater than or equal to 50% of both. So these would also be considered related parties. What about attribution rules? So stock owned by a family are deemed owned by an individual. So the partner who owns the stock in a corporation is attributed stock owned by another partner. And stock owned by an entity deemed proportionately owned by stockholders, partners, or beneficiaries. These are all situations where stock has to be attributed to someone. So let's look at this example. Craig and Alice are married. Alice is attributed Craig's 40% of First. First is an entity. Alice is not attributed Beth's First to stock. If Alice sells the property at a loss to First, she will be able to recognize the deduction. Let's look at this. If Alice is attributed Craig's 25% of First, and Alice is attributed 25% of First through the AB partnership, Beth owns directly 25% of First and attributed another 25% through AB, right? Because AB owns 50% and she's a 50% partner. Alice is attributed Beth's deemed and actual ownership and therefore is considered to own 100% of First. Alice cannot recognize any losses on property sold to First per section 267. So you can see because Alice and Beth together own 50%, Alice and Craig are married, so there she's another 25%. So essentially Alice owns 75% of First, which through the attribution rule now, she's considered to own 100% of First. She cannot sell property to First and recognize a loss. Hobby losses. So the taxpayer is presumed to have profit motive if he or she can show a profit for 3 out of 5 consecutive years. The IRS then will have the burden of proof to disprove the taxpayer's position. If activity is considered a hobby, then the taxpayer can deduct expenses only up to the amount of gross income. Property equals a residence, the taxpayer's residence, if the taxpayer's personal use exceeds the greater of the following: 14 days or 10% of the number of days the property is rented at fair market value. If a personal residence versus a rental unit, then the amount of deductions may be restricted under Section 280A. So if we have a vacation home and we use it either 14 days or 10% of the number of days the property is rented at fair market value, excuse me, then we can't consider it a sole income property, and our deductions are limited on that property. So here's a flow chart. So does it meet the residence test? If it's yes, is it rented over 14 days? If no, income's not reported, and the Tier 1 expenses are Schedule A itemized deductions, and then Tier 2 and 3 expenses are non-deductible. If it is rented over 14 days, income's reported on Schedule E. Tier 1 expenses allocated to rental use are deducted on Schedule E. Tier 1 expenses allocated to personal use are deducted on Schedule A. Tier 2 and 3 expenses are allocated to rental use and are deducted on Schedule E to the extent of the remaining gross income from the rental, so you cannot take a loss on this property. And the remainder of Tier 2 and 3 expenses allocated to rental use are carried over to the following year. Tier 2 and 3 expenses allocated to personal use are non-deductible, and passive loss rules do not apply on this property. If the property then does not meet the residence test, then the income is reported on Schedule E. Tier 1 expenses are allocated to rental use and reported on Schedule E. Tier 1 expenses allocated to personal use are reported on Schedule A and itemized deductions. Tier 2 and 3 expenses allocated to rental use are deducted on Schedule E, and the passive loss rules apply. However, you can take a loss on the property. Personal use of property includes the taxpayer's family uses the property for personal use unless charged fair market value rent. The property is being used under reciprocal use arrangement, and any day fair market value rent is not charged. Vacation homes minus the allocation, or vacation homes, I'm sorry. Let's talk about allocation of expenses. Expenses must be allocated between the taxpayer's personal versus rental use. If a taxpayer has personal usage more than 14 days or 10% test, then they can deduct expenses only up to gross rental income on Schedule E. Excess losses are carried over to future years. If personal usage less than 14 days in the 10% test, then the deductions must still be allocated but are not limited. So the calculation for this allocation, we look at the rental use expenses, and this will equal the total expenses for the year times by the number of rental days divided by the total number of days used. So this gives us a percentage of rental expense, and then all expenses are multiplied by that to determine how much is allowed on that Schedule E. And the rest would go on the Schedule A if the personal use days are met. Then if the personal residency test is true, then obviously you cannot deduct more than the income. If it is not met, then it's not for personal use. You can deduct more than the income on the property, but on Schedule E specifically, but passive activity losses are applied. Loss limitations, I should say, are applied. So that is the end of this chapter. Thank you for viewing Chapter 6. I'll see you again for the next chapter. If you have any questions, please let me know, and God bless you.